Good afternoon. Good afternoon. It's Monday, the 25th of March. Welcome to our latest edition of Monday Market Picks. My name is Tilan Vikramasinghe. I'm the head of research for Maybank Securities here in Singapore. Now, oil prices have been edging up with the WTI closing above $80 last week. This puts even more significance and a lot more focus on inflation, particularly going into inflation week this week. We have the US, we've got Australia, France, Italy, and even Singapore all reporting inflation numbers throughout this week. And that's going to put a lot of focus on where interest rates are going to go, especially in terms of rate cut expectations. So today we are going to look a little bit closer on the oil and gas sector, especially on some of the oil and gas support sectors in light of Petronas' latest results, as well as we're going to talk about two top picks. We've also got Jarek on the line to talk about his latest high conviction Opportunity Plus stock, Marco Polo Marine, also in the oil and gas sector. We'll also be discussing going into Vietnam and discussing VCB Bank, where prospects are improving, especially for the Vietnamese economy being upgraded to emerging market status. Plus, we've got two technical stocks on accumulation watch, so do stay till the end. But as always, let's start with the market movers. We did see some mixed reaction last week. The S&P was down about 0.1%, but the Nasdaq still charging ahead, up 0.2% after the Fed continued to keep interest rates where they are. That was widely expected. The Nikkei was up 0.2%, largely from despite the first rate hike in Japan after so long. The language that came out from the Bank of Japan was fairly dovish. And I think the market took that as a sign that overall monetary conditions will remain fairly easy there. Hong Kong went the other way, down 2.2%, largely as policy support from China continues to remain absent there. Southeast Asia was fairly mixed. STI was down just a bit, 0.1%, but we did see the KLCI up about 0.1%, largely from getting support from domestic infrastructure spending, as well as supply chains shifting. So quite a lot to absorb and look forward to. Please do download our newsletter. This has everything you need for navigating the markets this week. Now, let's move on to the oil and gas sector. Now, this is a sector that has fallen off the radars for a lot of investors because of sustainability issues as well as emissions issues. But now the sector is in a very unique position because there's been very limited investment upstream, and particularly even for the support services in terms of rigs and vessels and so on. And oil and demand is quite high. So that's actually driving a very unique situation of very high charter rates and day rates and so on, and as well as volumes growing. In fact, our analyst Jeremy Yap is highlighting that the US EIA is forecasting for record crude demand this year as well as for next year. All of that happening when supply is in shortage. So oil prices are going to be higher for longer. Now, if you actually read into Petronas' results from last quarter, one of the interesting aspects for us was actually the jump in capex. Forget about the profit and loss and where those ended up. But what was actually really interesting was the jump in capex. Capex is up about 5% in 2023, and a fifth of that went into clean energy and decarbonization projects. So oil and gas is in this position now where they have to respond to higher prices of oil and obviously get more supply. But at the same time, they are being constrained by the need to decarbonize and to reduce emissions. So that's actually creating a lot of opportunities within the sector, particularly in terms of the oil and gas supply services. So in Malaysia, we've got two topics from Jeremy. One of them is YINSON. Now, YINSON is the third largest FPSO leasing company in the world. They've got two new vessels coming online in FY25 and 26. Remember, their financial year ends in January, so slightly different from a lot of other companies. So basically, you're going to see a big boost in earnings coming through for calendar year 2024 as well as 2025 for YINSON. So that's something to watch out for. Also, they're very, very active in the ESG and emissions reduction space as well. So again, they'll be able to benefit from the high oil prices now and also benefit from the changes that are happening in the overall marketplace when it comes to sustainability. Our second pick is VELESTO Energy, which actually saw 3 contract extensions happening recently, and that kind of puts their rigs at work for the next 2 years. Plus, the very sort of tight supply in charter rates is also expected to continue going all the way up to 2025 as well. So again, a boost in energy as well as a boost in earnings, as well as a very sort of forecastable earnings as well coming through from VELESTO Energy as well. Now, coming into Singapore and staying in the oil and gas theme, we've got Jarek on the line. Jarek, welcome to the show.
Hi, Dylan. Thanks for having me.
Hi. So, Jarek, so let's start with, you've just initiated on Marco Polo Marine. Now, this is the Opportunity Plus stock. Now, for our viewers who are not familiar with what Opportunity Plus is a distinction we give for stocks where we have very, very high conviction on. So these have to be stocks that have very high conviction. We think that the stocks have very, very strong upside potential, and they have to be in the small and mid cap space. Now, if you actually look at our overall Opportunity Plus portfolio of stocks that we have given this distinction over the last 18 months or so, they've actually returned about 28% higher than the STI. So very, very strong track record of stocks. So please do pay attention to Opportunity Plus stocks as they come out. Now, Jarek, before we launch into the stock thesis, what does Marco Polo do?
Sure. Okay. Basically, Marco Polo, right? They are a long-time veteran operator in the chartering as well as the shipyards business. So basically, they own shipyards in Batam, where they do mainly repair and services for all the small to mid-sized vessels around the region. And because Batam is I would say they have a cheaper pricing because of the lower cost as compared to Singapore. So a lot of all these small to mid vessels, they'll go to Batam rather than places like, for example, Singapore, which is more expensive. And if you look at chartering, they have about 20 over vessels, of which half of them serve the wind farms in Taiwan. So that is the wind, or rather the ESG portion that we are talking about, where the company is moving towards more green energy, renewable, servicing the renewable sector. And the other half still serves the oil and gas sector. So the oil and gas sector will be somewhere between Indonesia and also to Singapore and Malaysia, so around this region. So basically, this company owns about 20 over vessels, of which half goes to wind farm and half for oil and gas.
Yeah, so it's also this very unique sweet spot where where you can benefit from the high oil prices, but also transition to low emissions. So what's driving your buy call on this stock?
I mean, if you look since the oil price crash in 2016, there's been a lack of investment in this space, due to firstly, banks are unwilling to lend. So if you look at Singapore banks and Malaysia banks, right, you try to get an oil and gas company without a state backing or strong backing to borrow even $1 from a bank, they will say no. Right. So that's one. Second is that, a lot of companies have all died off. So the smaller and the ones who can't survive the crisis, they have all gone bust. Right. And also there's no reinvestment in this space because companies who survive and finish their debt restructuring are unwilling to add new vessels because they don't have money and they can't get funding. So what happened is that, if you look at this space, basically supply hasn't gone up much. And there's also this replacement capex that needs to be done because vessels get old and they cannot be used anymore. And so far, it's only been up to the replacement capex. And if you look at the demand from oil now, it's surging. It's actually surging. The number of barrels of oil produced a day is actually more as we get, increasing year on year. And if you look at what's happening now also is that the offshore renewable energy sector, like the offshore wind farms, the offshore solar farms, they are also competing in the same type of vessels that we are talking about. So basically now you have oil demand increasing, and not just that, you have the renewable sector coming in to fight for this same pool of vessels that are serving just the oil and gas sector. So what has happened is that demand has shot up, supply stays the same, and that has resulted in charter rates increasing for the last 3 to 4 years, close to about 5% to 15% per annum. And that has led to those operators getting I would say a good heyday, for the times they have suffered since 2016. So if you look at Marco Polo, since 2020, their earnings have shot up, year on year, because margins have shot up, and also basically operating leverage has also went up. So charter rates go up, operating utilization went up, and that led to gross and net margins going up. And we do think that this will likely continue into the near future, because if you look at the next 2 to 3 years, actually 2 to 5 years kind of pipeline, there's a lot of renewable wind farms, offshore solar that's coming out in Vietnam, Japan, Taiwan, around the region. So that will create, that will actually help to create more demand against the oil and gas sector, which is really doing well now. So if you look at what the rates are in the Middle East, they are actually 20 to 30% higher than what the rest of Southeast Asia are charging. So that gives you sort of a sense of what rates could potentially go up to going forward as well. So we are very bullish on its results. We think that in the next 1 2 years, or actually the next 2 3 years for Marco Polo, we are estimating at least another 20 to 30% CAGR of earnings growth, just from high utilization and also higher charter rates. And not just that, if you look at Marco Polo has also start building a CSOV last year. And the CSOV will be to serve the wind farm sector for its key customer Vestas. And that's been already locked in for a 3-year contract with a 50% minimum utilization rate. So key is that they will not lose money for this vessel. And for the first year, starting October this year, they have already locked in 80% utilization for this vessel for 2025. FY 2025, because at year end. Yeah, so if you look at CSOV, they'll contribute about 20% net profit for 2025, 2026, right? So your earnings growth is already minimally there. And basically, this business is like a REIT, right? You buy a vessel, you charter it out, then you get a free fixed income flow. So basically, once you have a utilization 80%, that means that your profits will just flow in based on your cost base. So if you look at what's their trading valuation, they're trading at about 6.9 times, or rather 7 times roughly now. They have a lot of new vessels that are coming aboard, one CSOV, and potential new vessels that they can build for new clients. So I think if you look at the recent announcement after my initiation, they actually announced that they secured a new wind farm customer, Siemens, and they are actually trying to build CTVs or supply them CTVs for chartering for the wind farm sector as well in Taiwan. So that is another growth area that we have actually not inculcated into our earnings, which could provide a potential uplift. So they're going to start with 2, and they're planning to increase to up to about 15 to 20 in the next 4 to 5 years. So that could be a potential re-rating for a stock. And the next, I would say, key catalyst is that they will work with their key partner, key customer Vestas, to also supply more other vessels like your SOV. And this will be done likely in a longer term contract, which is like 10 years. And with the 10-year contract, they could then go to Taiwanese banks and say that, hey, I need some funding for this vessel, and it's already locked in. So financing won't be a problem. They should be able to grow faster as long as they can secure this 10-year contract or long-term contract. So that's another key catalyst. Another one would be strong earnings. We do expect first half of 2024 earnings, or rather 2024 earnings in general, to be strong. Yeah, so that could be, once the earnings come in, then that could be another potential re-rating. And of course, the CSOV building completion will also be a catalyst, because this is the first CSOV they have started to build. And I think the market wants to have more certainty that they can actually build and deliver the ship before the stocks get re-rated as well. So these are the few catalysts that we are looking out for in the short term. Yeah.
Okay, so a lot to look forward to, right place at the right time, stock as well. But let's just quickly touch on what are some of the risks that you see as well on the downside.
Yeah, so for the risk, I think because they operate in Taiwan, so I think the risk of a Taiwan-China conflict, it's there. So assuming that, that happens, which I hope not for it not to happen, but if that happens, then you could potentially lose half your revenue source, especially from the Taiwan wind farm side. But vessels will not be an issue. I mean, they can actually remove the vessels. That means that they will sail the vessels out of Taiwan, but you will temporarily lose the income from there. And they will then have to revert these vessels back to the oil and gas space, which will not happen so fast. Then this may result in a drop in charter rates, which will impact their margins and all. So I think this is one of the key risks. Second key risk would be that, if the oil price starts to come down significantly, there might be a drop in terms of charter rates as well. But as long as the oil price stays above $60, we do not think that this will impact the charter rates at all. Yeah, due to the demand for now. So I think these are the key risks that we are seeing for Marco Polo in the next few years. Yeah.
Got it. Excellent. Thanks, Jarek, for this.
Welcome.
We'll have you back on the show again soon. Now, let's shift focus on a stock that an analyst in Vietnam, Than, says can be a proxy to the Vietnamese market itself, and that's VCB. Now, there's a lot to get excited about Vietnam. You've got supply chains shifting from China into Vietnam. He's been a big beneficiary of foreign direct investment, and the stock market has the potential to be upgraded from a frontier market status to emerging market status. Now, that's actually quite a big thing, because once you actually get classified as an emerging market, a lot more institutional investors can take part in that market versus a frontier market. Plus, we also just heard that the State Securities Commission there is asking for opinions on reducing pre-funding requirements for stock trading, which can also be a positive catalyst going forward as well. So with all that, why VCB though? Now, this is a stock that that actually is quite easy for foreign investors to get a stake in and have a lot more access, given that it has quite a bit of room on its foreign ownership limit. So it's a lot more easier to get access to this stock. The stock itself is throwing off around 18 to 19% ROEs. That's what Than is forecasting for the next 3 years, and got a very strong balance sheet. So with all the volatility in the banking sector and a lot of the other uncertainties around there, this is going to be one of these stocks that are that provide a lot of stability as well as earnings visibility as well. Valuations are very cheap on a relative scale, trades at about 2.6 times price to book. Now, if you look at some of the other more proxy stocks in India, like HDFC Bank, or in Indonesia, these trade at 4 to 5 times book. So there's a huge valuation gap from a market that is becoming more and more in the radars of institutional investors, and you've got a very strong domestic retail base as well. So our target price has almost 45% upside from current levels. So it's definitely worth having a look at VCB at these sorts of levels. Now, let's quickly turn to technicals. Nick, our chart guy, can't join us today. So I'll run through very quickly on 2 of his technical trading ideas. The first is KEPPEL. The ongoing uptrend for KEPPEL is set to continue over the next few weeks. The last few weeks gain is actually sending a very bullish signal on the stock. And Nick thinks that it'll continue to have very positive momentum behind it. The next stock is Centurion, which has formed a double bottom pattern from its earlier move on the 14th of February. And Nick thinks that from these levels, the stock has a lot of momentum behind it to trade higher in the near term. So do have a look at both of those stocks in a lot more detail in our newsletter today. Now, I see a couple of questions. I don't have time to take all of them, but let me just take the first one from Kristan from the audience. And he's asking, what does the team expect from inflation data? What does that mean for the MAS in April? And then the Singapore near, and what sectors should benefit from from easier or tighter conditions? Now, Chris, our house view is that inflation in Singapore will remain sticky. And not just because of external factors, but also domestic factors like the GST hike. We've got carbon taxes coming in. We've got progressive wages and things like that. So overall inflation in Singapore, even if inflation starts to fall in some of the other neighboring countries, will remain a little bit more stickier. So we don't think the MAS will ease so soon in April. We think the earliest that will happen is in October this year. Now, if there is a surprise easing, it could weaken the Sing dollar and over time also lead to lower interest rates. As you know, the MAS does not control interest rates. The free market does. The MAS only only manages the Sing dollar. Now, the weaker Sing dollar from a FX point of view will impact mostly from a translation point of view. If you look across most of the large cap stocks in Singapore, as well as some of the more medium stocks, a lot of them either report in the main operating currency. So a lot of them, which are US dollar revenue based, actually report in US dollar and so on. So the overall FX impact will be fairly limited. There will be some support for areas like the banks, some of the export oriented companies, which report in Sing dollar, but you know, and a weakness there can provide some translation gains. The lower rates over time can be positive for some of the more higher geared companies, as well as some of the REITs and some of the small and mid cap companies as well. So I hope that answers your question. Now let's have a look at some of the upcoming events. As I said, we've got inflation data coming through soon, as well as industrial production numbers as well. The Singapore Bank lending numbers coming out on the 28th of March. The PMI numbers coming out on the 2nd of April, and URA property index prices out on the 3rd of April. So it's quite a lot to watch out for in this week, as well as the early part of next week as well, despite the long weekend. In terms of events, we've got a Thai refinery day coming through again in the oil and gas theme, so quite timely, I think, on the 26th of March. So do speak to your salesperson to get yourself registered for this event. With that, we are unfortunately out of time. Thank you so much for joining us this week, and have a profitable trading week. See you next week.